benefit of others joining shortly, we'll just be giving them another maybe 2 minutes. After 2 minutes, we will proceed. Thank you. I think we have a pretty good number of attendees. I think we can start. Good morning, everyone. I'm Jahangir Burhanov, Commercial Director at RAK ICC. I would like to extend a very warm welcome and thank you all for joining us today. We're delighted to host this webinar in collaboration with Virtuzone and TaxReady.ae on a topic that has become increasingly important for the businesses, advisors, and private wealth professionals across the UAE. As the UAE corporate tax landscape continues to evolve, understanding the tax implications for holding companies and foundations is more important than ever. Today's session will provide practical guidance on structuring, compliance requirements, and common pitfalls, helping you better navigate the current regulatory environment. I'm very honored to have John Casey with us today. John is the Managing Director of TaxReady.ae, a Virtuzone Ascentium company, and brings more than 20 years of international experience across tax, professional services, banking, and legal advisory. We look forward to benefiting from his expertise and practical insights today. Thank you once again for taking the time to join us. We hope you find today's session informative, practical, and valuable. With that, it's my pleasure to hand over to John Casey. John, welcome. Thank you.
Thank you, Jahan, and good morning, everybody. Look, just before we get started, at the top of the screen, all of you that are joining on Teams, you'll see a little button that says Q&A. Now, as we go, please send through your questions, type them in. I will always try and answer these questions in the relevant part. I find that's much more useful than waiting until the end and trying to go back. We'll sort of address these as we go, especially if there's a recurring theme that might be relevant to others. So please, be forthcoming with your questions. Type them into that Q&A box. I see a few of you are popping things into chat as well. If you could use the Q&A box, it's just a little bit easier for us to track. So without wasting any more time on that, I will share my screen and we will get into it. Okay, so a little bit first on what we'll actually cover today. So look, as with all, with all of these webinars, what I will always cover first is the basic things that every organization has to do. So the compliance steps that you just cannot avoid. Most of you will already be aware of this, but we still get, multiple clients or new clients every week that come to us with a 10,000 dirham fine. So they're starting off that point. So we'll cover that first. What we'll do, for this webinar particular is we're going to go into a bit more complexity. So, often with these webinars, we'll stay quite high level, but given that, your average RAK ICC client or customer is a bit more complex, or let's say a bit more financially astute, we'll go into a bit of detail specifically around exemptions and obviously foundations as well. And we'll spend a good bit of time on foundations. And then we'll sort of finish off by covering, okay, well, under what sort of structure, what sort of compliance deadlines actually apply. So first of all, the absolute basics, okay? Every single entity, you have to register for corporate tax within 90 days of being established. Now, this makes no difference if you are a foundation or a holding company or an SPV or a family office. It makes no difference if you have a bank account or not. It makes no difference if you don't have any assets yet. None of that makes any difference. The moment that the entity is established, whether that's a company or a foundation or anything else, the timer starts on that 90 days and you need to register for corporate tax. Okay, 10,000 dirham fine if you miss that deadline. So please, there's no reason to delay. As soon as you get that entity open, go in and register. Registering doesn't necessarily mean that you'll be paying tax. And it has the registration has no sort of downstream repercussions. Okay, so regardless of what kind of entity you are, you first need to get yourself established on the FTA portal. I know that would sound very, very basic. I'm sure most of you have already done this step, but like I said, it's just worth reiterating whenever we have these discussions. Okay, straight into holding companies. Okay, now just a reminder, at any point during this, please put in your questions, tick that Q&A, click on that Q&A box and write your questions in there, and we will cover them as we go. So first of all, we're going to focus on holding companies. Now, this also has further downstream impacts on foundations, but we'll get to that. So first of all, we'll specifically be talking about holding companies and what, that there are multiple exemptions available to a holding company and what that sort of looks like as you walk through the different asset classes. So the exemption pathway of a holding company always depends on asset class. So when we say exemption for these purposes, I'm talking about an exemption from corporate tax. And it might not necessarily mean an exemption, but this is the way in which you effectively have a tax rate of 0 on your holding company. So the first thing we look at always is the type of asset or the asset class. And it's quite prescriptive around this. So you can walk through this and it's basically tick box, tick box, tick box. So if your holding company only owns UAE equities, so if you have a holding company, it just owns your operating UAE company, okay, the dividends paid from your active UAE company to your holding company will always be exempt. So dividends paid within the UAE between UAE entities is always exempt. It works on the principle that those taxes have already been, that profit has already been taxed in the active company, right? And so they don't tax that profit again when it gets paid as a dividend to the UAE holding company. Long way of saying, if your holding company just owns UAE equities or other UAE companies, then there will not be any corporate tax paid by the holding company on those profit distributions. And the same applies when the holding company sells those equities as well. So the capital gains aren't taxable either. Let's say that you own UAE equities and you also have your holding company also has shareholdings outside the UAE. This is when you can look at an exemption pathway called the participation exemption. Now, the rules around this are that you must own 5% or more of the other company, or the purchase, the acquisition, cost you more than 4 million dirhams. Basically, that is a way of the FTA saying, okay, this is a substantial investment, all right? You have effectively suffered tax in that other jurisdiction or that other country, and so we're not going to tax you again here in the UAE. Now, that only works if that other country has a corporate tax rate of 9% or more, so same as the UAE or higher. And this is where we first see this rule around holding activity being 12 months or more. Okay, so whenever we talk about holding is always a holding period of 12 months or more, or you must show that you intended to hold the shares for 12 or the equities for 12 months or more. The reason we have this 12-month rule is to differentiate between a company which is genuinely holding long-term versus a company who has a trading, a share trading activity or an active business of trading shares and equities. So when we are talking about holding activities or holding period, we are always talking about a 12-month holding. So if we're looking at foreign equities, the participation exemption is available, as I said, if you own more than 5% of that offshore company, or if it costs you more than 4 million dirhams. So generally it would not include, if you've got a share portfolio with, shares in Apple and Alphabet and Nvidia, right? You're not going to own 5% or more of any of those companies. It may be that your acquisition cost more than 4 million if it was in one asset class, all right? In which case that would fall into it. So I've already got questions coming through. Now, when we are talking about the UAE equities, the foreign equities, and the rest of these exemptions as well, we are talking about an exemption on all proceeds or all profits from that holding. So it's not just the dividends, it's the capital gains as well. So any proceeds from or any distribution of profits, which includes the sale of the equities. Now, let's say, so you own UAE equities, great, that's exempt. You also own foreign equities, okay, you own more than 5%, great, that income will be exempt. Let's say that you also own other financial instruments, so bonds, crypto, or you own foreign equities under 5%, so you don't meet the participation exemption, okay? This is where we start looking at the free zone exemption. So a RAK ICC holding company has the prior two exemptions available, but more importantly, it is eligible for this free zone exemption under a holding activity. There has been, for those of you that are a bit more sort of informed around the landscape at the moment, there has been some debate around free zone statuses of offshore zones, but that is all underway with being cleared up with the FTA. So right now we are proceeding on the basis and have proceeded on the basis that all offshore zones like RAK ICC qualify as free zones and therefore are eligible for these exemptions. So how does this holding activity free zone exemption work? So the first rule is around what classes of assets you hold, okay? So as we've stated here, all financial instruments, foreign equities, obviously you can also own UAE equities and foreign equities over 5%, right? And those can also be included in the exemption. So just to clarify, as we go down this list, it includes everything above as well, okay? So nothing if you qualify for one of the levels, you automatically qualify for the levels above where we're going through this. So the holding activity free zone exemption. So we know what the asset classes are, okay? You must hold these assets or show intention to hold for 12 months or more. That's that, holding activity as opposed to actively trading. The second part of this is the adequate substance test. And this is where the tax authorities have given us a very clear example, which is if you hold the decisions around your investing activity, so if you make those decisions within the free zone itself, and you can demonstrate that through, board minutes, dated with the location, within the free zone itself, then you can show that the management of the business or the revenue generating activities is the technical term, happened within the free zone. For those of you familiar with the old economic substance rules, it's similar to those. However, for this free zone exemption, instead of just showing substance in the UAE, you need to show your substance in the free zone itself. Again, there will be more announcements around this for RAC-ICC, around physical locations and how to satisfy this test. But the rule is, the rules are so far, you've got to hold for 12 months or more. You've got to show that you had adequate substance, which means making any investment decisions or substantial investments decisions actually within the free zone itself. And then if you have other income coming through, so let's say you have all of these coming through, but you also, you sold some office chairs, all right, and you received income for that. Now, as long as that it's called non-qualifying income. So as long as that income outside of the holding activity, as long as that is less than 5% of the total income of the business, that's revenue of the business, as long as it's less than 5%, then you don't ruin the exemption. However, if more than 5% of your income in the company is non-exempt or non-qualifying, the entire company loses the exemption. So this is something you do need to be very careful about, and this is when we get into some of the non-exempt or non-qualifying asset classes. So going into those non-qualifying asset classes, the biggest ones are IP. Okay, so IP licensing doesn't fall under holding activity exemptions. There is a separate IP exemption. However, it operates very differently, and the two, holding company and IP licensing, it's very difficult the way that the IP exemption works. It's very difficult to have that blended into the same company as the holding activity and still maintain the exemption. Okay, so if you are going to have a holding company and which holds the asset classes that we've covered so far, so basically equities and other financial instruments, if you're going to have those plus other asset classes such as IP, but more importantly real estate, which we'll get to, you always want to segregate IP and real estate into a separate entity. Okay, because of that 95% rule, right? Having all of those assets under the same entity, you might have 80% of your income coming from your financial instruments and equities, but the fact that you have 20% coming from IP or real estate, that means that the entire entity loses the exemption, okay? Because you've dropped under 95% from exempt activities. That is a long way of explaining, right? The structure here should always be financial instruments housed in one company, in your holding company, okay? That should always hold your long-term financial instruments and equities. Real estate should be held in a separate entity, which we'll go into, or in your personal name for real estate, which we'll also cover. Any IP, so trademarks, any software IP should be held in a third company, right? And then if you are also doing active share trading or active crypto trading, that should always be ring-fenced into a separate company again. Okay, that is the most tax-efficient way to do it. Now, that obviously costs money, so you might look at that and say, well, actually, my tax saving on this is only going to be 10,000 dirhams, so I'll just combine them all together and run it as one. But if you're looking at significant assets, you're owning real estate under a company structure, you absolutely need to ring fence these into separate entities so that you don't trigger or you don't lose an exemption for your holding company. Okay, so everything we've covered so far, these first 3 steps, is all focused around financial instruments and equities. Okay. You'll see that nowhere in those first 3 steps have we mentioned real estate. So, real estate, as a general rule, is never exempt under corporate tax, okay, when owned by a company. There is a a structure you can put in place to make it tax efficient, which we will go to in a second, which is through the foundation structure. But under a company, real estate is almost never exempt. There is one small exemption, which is it is only exempt either in the foundation structure, which we'll go through, but if it is in a company, if it's commercial real estate, which is located in a free zone, and the income is derived from another free zone company. Okay, so we're getting very specific here. So you've got a free zone office space. The tenant is a free zone company. Only then would that income qualify for the exemption. Okay. Any kind of residential real estate or any real estate outside of the free zone, sorry, that is not exempt. And that is why if you hold your real estate in your holding company and it's residential property, for example, that runs a really big risk of you losing the exemption for that company altogether. So Sunny, you've just asked, rent earned by properties, is that exempt? No, unless it's in a free zone and it's rented to a free zone company, but that is very high risk. So generally we would never recommend holding real estate under a holding company unless it is through a foundation structure, which we'll cover in detail shortly. So look, on the screen now, we're just covering those exempt or those non-exempt activities. So this is what you should always house in a separate entity from your qualifying holding activities. So your holding company should really just hold your equities and financial instruments, which you'll be holding for 12 months or more. So long-term holdings. Everything else, you can either put it into separate entities or you can put the non-exempt stuff all together. And then, that way you still maintain the integrity of your holding company exemption. Same rules apply to, Alexandra, your question, same rules apply to ADGM and DIFC. Okay. So corporate tax is a set of federal laws. It's not emirate level laws. So these apply to, all free zones and all, offshore zones are being considered as free zones, as we're seeing right now as well, particularly RAC ICC. And we have indications from the FTA that we'll be getting clarification on this soon to confirm it. Okay, so we'll just jump back to this one final time. So we're about to go through the last option, so transparent foundation. Okay, foundations. So first of all, I just want to talk about real estate. So real estate investments, as a rule, is normally better to hold in your personal name. Okay, so as we're all aware, there is no personal tax here in the UAE. Okay, and more specifically, there is no personal tax on wages, obviously, so your salary. There is no personal tax on investments, so financial instruments, and there is no personal tax on real estate investments either. So real estate, when held in your personal name, will always be exempt. However, we know that the reality is that many people want to put real estate under a corporate structure or a legal structure for asset protection, for succession planning, for many, many reasons, okay? And so we get in this situation where, okay, well, I want to put real estate into a legal structure, so it's not in my personal name, but I don't want to be paying 9% corporate tax, when I sell this villa or when I sell this property down the line. The way that the tax law addresses this is through the foundation structure. Now, a foundation structure does not automatically qualify for an exemption. Okay, so a foundation, when you open a foundation, is treated no differently to any other company. Okay, so it's the same as a holding company. So when you open the foundation, in the eyes of the tax law or the tax authorities, you have just opened a company for tax purposes. However, you can elect for a special type of treatment specifically for a foundation where you can apply to be treated as what's called a unincorporated partnership, which is the technical term for just saying it is transparent. So what that means is that the tax authorities do not consider the foundation at all. Think of it as completely transparent and visible. The tax authorities will look at the named beneficiaries of the foundation and treat all the income of the foundation as if it was received directly by the beneficiaries themselves. There are some rules around this, so the beneficiaries need to be specific, types of, well, they need to be natural persons, right? So you can't, this doesn't work if you have a company as the beneficiary, but, in 99% of cases that we deal with, the foundation is set up, there's a founder who is also a beneficiary, and maybe there's one or two other beneficiaries as well. This structure all hinges or all depends on the tax residency of the beneficiaries. Okay, now the reason for this, if all the income received by the foundation is being treated like it is going directly to the beneficiaries, okay, that's great if the beneficiaries are personally tax resident here in the UAE because there's no personal tax. Okay. However, it doesn't work if the beneficiaries live, let's say, in the UK or in Europe or in the US, right? Because all of a sudden, those beneficiaries are receiving a large amount of personal income, and that will be taxed based on their personal tax residency over in the UK. So you're saving, 9% corporate tax to end up paying 44% personal tax, over in the UK or Australia or wherever the beneficiaries live. So the first question we always ask when we are considering the structure is, who will the beneficiaries be and where are they tax resident? Where do they live? Of course, now, again, probably 75% of the foundations that we look at or the clients that we look at have the structure. It's highly efficient. They live, it's normally the founder is setting themselves up as the beneficiary themselves. Okay. Sole beneficiary for now. And in the bylaws of the foundation, it says, they say, when I pass away, the beneficiaries will change from me to, my children, my wife, whoever. Right. And at that point, they become the beneficiaries and they start receiving that income personally. One additional thing about this treatment is that you can turn it on and off. So right now, you might be living in the UK, you set this up, you don't want the transparency yet, so you can file a standard tax return. But let's say next year you've moved to the UAE, you're a tax resident in the UAE, you've relinquished your UK tax residency. Next year, you can then flick the switch, turn this over, and it can be a transparent entity and you can, effectively be completely tax-free under this structure. So it's not a one-time, set and forget decision. You can change in and out of this election, which is very different to a lot of other ways that the UAE tax law works, like around exemptions. You've got to sit out for 5 years if you don't go for it. Various other rules, once you select something, you can't go back. With the foundation, with this unincorporated partnership election, you can choose to do it in a given year and then change back the following year. Now, again, if you only have financial instruments, equities, long-term crypto, and you don't hold real estate, there are other avenues for exemption, okay? However, the minute that you are looking at bringing real estate into this legal structure, into a legal structure, immediately you should be considering a foundation. Okay, some good questions coming through here. Okay, I'll just go through how a bit more on the foundations, and then we'll circle back. We'll come back to a few of the questions that are coming through. Okay. Now, for these examples, I've used the asset as a property, but just keep in mind that it applies to anything that is exempt under personal tax. So it could be a property in a real estate, but it can also apply to shares and other financial instruments, bonds, crypto, everything like that. So under a standard, so first line here, the first illustration, basically just pointing out how this works at the outset. So the moment that you open the foundation, it is treated as a taxable entity. And, especially in the case of property, the foundation would pay 9% tax, the same as any other company. And then the distribution from a foundation to the beneficiary would not be taxable in their personal name, because that's treated as a dividend, or effectively a distribution. All right. So in that way, in this case, you're paying 9% on the property income tax. Sorry, on proceeds from the property. Pretty basic. If you instead elect for this transparency for the foundation, any income from the property is considered by the tax authorities to be derived directly by the individual, or received directly by the individual. And if they are here in the UAE, then they don't pay any personal tax on that. Again, illustrates the risk if that person is living overseas, somewhere with a high personal tax rate, because they would be liable for all the proceeds from that asset. Okay, I think that's pretty straightforward. We're about to go into the next layer of foundation structures, which is around combining the two. Okay, so holding companies or other companies sitting under a foundation. Okay, so let's say you've got a foundation, you want to own a property, but you also have another company in the UAE, you've got a holding company, you want to put it all under the foundation. Okay. What the UAE tax law allows is that if a company owns assets which would also be eligible for the foundation transparency, then that company can also elect to be transparent. So the foundation treatment of transparency can extend further layers down your structure if everything would qualify for this, for this transparency. So if we look at that top line of diagram, this is what the structure looks at the outset, okay, before any election is made. So let's say that a company owns a real estate asset, or let's say that the company is a holding company and doesn't qualify for an exemption for whatever reason. So the company is taxable on the profits from the the real estate. The company obviously pays 9% on that, or if it's overseas, could pay more. Now, the distribution from that company to the foundation normally would not be taxable, but could be if that company is overseas, for example, and doesn't meet the participation exemption. Okay, so it could be that the foundation then has to pay tax again on the income from the company. Okay, so you could be faced with effectively two types of leakage. Normally, if this is all in the UAE, the company would pay 9%. It would pay a distribution or dividend to the foundation, which wouldn't be taxable, and then it wouldn't be taxable to the individual. All right, but the main thing here is that the company would have to pay tax on that property transaction. Now, what the UAE tax law allows is that the foundation can apply for transparency, and the company underneath can also apply for transparency as a subsidiary, effectively a subsidiary of that foundation. Okay, so as long as the asset class satisfies is the same as this, right? Effectively, you can have a company in the middle, and as long as it just owns this, right? The company can be ignored as well for tax. So the tax authorities ignore the company, ignore the foundation, and treat it as if it is just received directly by the beneficiary. This is a really significant rule available, especially when we are looking at, and sorry for jumping around, when we're looking back at this, right? So, oops, sorry, at this slide. Okay, so looking at the non-exempt activities. So we have clients who have a foundation. Underneath the foundation, they have an IP company, they have a holding company, they have a real estate company, and they have an active trading company. And we have been able to have that foundation transparent, right? With transparency through the real estate company, the holding company, the trading company, the real estate company, the IP management company under a separate exemption, okay? And then the trading company is also transparent through to the individual. So, and a structure that would have been taxable in multiple different ways previously has become completely transparent through this structure, whilst also housing different asset classes in different holding companies or different companies, meaning that when it comes to an exit, for example, the client is looking to sell their IP assets, right? That doesn't ruin the exemption for anything else, okay? This is, we are getting a bit complex here. However, I know that, like I say, your average RAC ICC company has, a lot more complexity, and everyone seems to be much more onto it with these things as a compliment, is what I've noticed. And so, these structures are something that you should really be considering, especially when you're looking at asset classes outside of standard holding. Okay, I've got quite a few questions coming through. So before I go on, I'm just going to go back through a few before I jump to the compliance steps. So please, please send through any questions right now if you have any more. Okay, Conan, your questions. So sale of UAE. So jumping back to here. So UAE equities, you don't need to satisfy the participation exemption. Okay, participation exemption is only on foreign equities. UAE equities, you don't need to own more than 5%. There's no restrictions on on the exemptions for UAE equity holdings. Okay. I'll just jump down to the free zone exemption. So 95 at the very bottom there's a question around this. So 95% of income must come from exempt activities. So I used the example of selling office chairs, okay? That would, and Conan, it's a good question. So Conan has asked whether, selling office chairs would be considered what's called an ancillary activity to a holding company. So the nexus between, it has to be a direct relation to a holding company and the nature of that activity. So selling office chairs, just because a holding company has an office, doesn't mean that office chairs is an ancillary activity. Okay. Holding company activities, if it was, if you earned interest on a bank account, which was, or you got refunded a transaction fee or a kickback or something like that, if it's directly, it has to be a really strong nexus or a really strong connection to the actual activity. It can't be a incidental. It's got to be actually directly related. So, I would not say that selling office chairs would be a directly related activity to a holding company, but it's a good question. It's very detailed. Just jumping through a few more questions. Again, questions here around foundation beneficiaries. So the beneficiaries of the foundation need to be natural persons or a recognized, it can also be a recognized charity. Okay, so just jumping back to this. So the beneficiary of the foundation, to be transparent, needs to be a natural person or a listed charity. I think most of you will be aware that the UAE has a approved list of charities here that that you can donate to. So it has to be one of those charities or an individual. Okay. Lots of questions here on the chat. So give me 1 minute. I'm just going to run through them, see if I can get the theme. So the holding company so questions here around substance for a holding company. Okay. ADGM offshore, RAC ICC, I know there are various offshore jurisdictions. That's a bit of a watch this space. Okay. So we know, we have had very strong indication and have had returns accepted that, these entities do meet the criteria. For substance, okay, so RAC ICC, again, you'll be seeing something in the near future around how this gets satisfied for RAC ICC. So, physical office or physical location where you can actually satisfy that that requirement. A question here: if an ADGM holding company, foundation holds real estate, but the beneficiary is tax resident of another country, will the foundation be exempt? So the key point here is that the foundation itself is not exempt from tax. Okay, so if we're looking at this here, it's not like the foundation is exempt from tax. It's more that the foundation is completely ignored, as if it doesn't exist. The tax authorities say, okay, instead of this property being owned by the foundation, we're going to treat it like it was owned by the beneficiary. And therefore, any income from that property is directly going into the hands of the beneficiary. So Alexandra, in your question, if the tax resident, if the beneficiary lives in another country, is tax resident in another country, right? You can still do this transparency, but it is unlikely to be tax efficient because the individual should be declaring that income in whichever country they are tax resident. So if they live in the UAE, this structure makes sense because they will show that property income in their personal tax return. Well, no such thing as a personal tax return, right? However, if that individual is tax resident in I'll say New Zealand, my home country, right? If I was living back in New Zealand, I would never do this because I would be personally taxable on any proceeds from that property sale. Whereas if it was still the foundation would pay 9%, and I would not be liable for tax myself unless the foundation made a distribution to me from that. I hope that explains, Alexandra. Yeah, pop on another question if you need further clarification. Okay, I think I've covered the general themes there. So we will, there's a question here around, multiple directors. Can one director be in the UAE and another outside the UAE? So, Vidiak, the question here is around who play, and sorry, I'm jumping around then I'll jump back on the slide so you know what we're talking about. So what we're talking about for this question is adequate substance for the free zone exemption. So showing that investment decisions are made within the free zone. So if you've got two directors, One's in the UAE, one's outside the UAE. Can you still meet the substance requirement? So in this case, it's more about establishing what the role is for each director. And in this case, you would be saying that, okay, or establishing that the director who lives in the UAE, you would establish that it is their role to make those investment decisions, to make those, so-called revenue generating decisions, and entitle that. So, the international director, can still dial in, right? But as long as the UAE director is still at within the free zone making those decisions, and it is established that their role is to make those decisions, then you satisfy the requirement. Okay, let me just jump back. I think we are up to date on those questions. Great. All right, we'll jump ahead. So whether you go through the foundation structure or the holding company structure or a combination of both, right? Different compliance steps will apply to you. So the main thing here, as with all corporate tax rules, is you have to go and take some kind of action. You have to go and do some steps to take advantage of these rules and exemptions. So for holding companies, or for all companies and foundations which are not going to be transparent, you'll remember I said a non-transparent foundation. So the foundation, when it is established, it's treated the same as any other company before you do transparency, or if you don't do transparency. So for those entities, obviously you've got to register for corporate tax. You've got to do a proper set of accounts. If you're going for the free zone exemption, so going for that holding company free zone exemption, you've got to do an audit, and you'll always have to file a tax return as well. Okay. Now, remember, these rules apply regardless of what the company is doing. Even if it's an inactive company, it's doing nothing, you haven't transferred any assets yet, you still need to go through these steps. Obviously, the accounting records are going to be pretty light if you don't have anything in there yet, but you still need to file everything. You still need to file a set of accounts, even if it's blank. Okay, you can't just submit a set of bank statements or anything like that. So fines always apply. Okay, if you don't go through these compliance steps, right, then you start incurring fines pretty quickly. Okay. Again, I want to really draw the difference here between compliance steps versus actually paying tax. You won't necessarily be paying tax, but you always have to do the compliance steps. Okay, that's the key thing to remember. Foundations. Okay, so when we're talking about the transparency, so always you have to register for corporate tax. That is when you actually put the foundation onto the FTA portal, and through that or following that registration, you do the application for that transparency, the application for unincorporated partnership. Now, this is where we've seen a little bit of difficulty, which is around this application. So the application has to be made before the end of the tax year. So as of right now, you cannot apply for 2025. Okay, so if you have a foundation which had its first tax year in 2025, I'll go through the timing in a second. But if you already finished a tax year in 2025, then you can't apply retrospectively. It has to be done before the end of the tax year. It's very different to how other tax laws work, which normally gives you time from the end of the tax year or end of the financial year to get your application in or submission in. In the case of the foundation, it's got to be done before, in most cases, before 31st of December. Right? So please, if you've been listening to this and you say, okay, that structure might make sense to me, please get onto it sooner rather than later. We have to get the application in before the end of the year. Okay, we have had cases where the client comes to us on 23rd of December, realizes that they need it in, and we get the application. It might not be fully complete, but at least we submit it, and then the FTA can come back for more information and things. But the main point here is that you get that application in before the end of the year. Please, I use that as an example. Please don't wait till the 23rd of December. you'll certainly ruin Christmas for someone. So please, get it in as early as possible. There's no point in waiting with this stuff. The application can take quite a while. The FTA will often come back asking for, to demonstrate that there are assets on the balance sheet and things like that. You need to also show that the foundation is not doing any active business activities, which you wouldn't be anyway because it's not permitted. So yeah, there's a bit of work involved in this. So please don't delay if you are considering this structure. And then each year for the transparent foundation, you don't have to file a tax return, but you do have to submit a confirmation each year that you want to remain transparent. Okay, and this sort of follows on from that ability to switch the transparency on and off. So if you're transparent this year, you can decide to be non-transparent next year. Let's say that you leave the UAE and move to another country and you want to switch it back to non-transparent. You can do that the following year. Okay, I'm going to quickly cover this because we still get this question a lot. I've talked about when your first tax period is for getting or when the tax period finishes for getting your application in as a transparent foundation. Now, the easy way is check your corporate tax registration certificate. It will always show your first tax year, your first financial year, and it will also show your first filing deadline. Okay. If you don't have that available, we have cases where it's in Arabic or it's not shown if it's an old corporate tax certificate. If you have a old corporate tax certificate, right, which doesn't show the financial year, if you go into your FTA portal or on your old corporate tax certificate, there is a QR code. Scan that and it'll bring up the new version and that will show these details. But for the sake of covering this now, the rules around this, and don't worry too much about why it works this way, just sort of one of those ones where you just got to trust me that this is how it works. So look, if you had your company open prior or your foundation open prior to June 2024, right, that means that your first financial year ended back in 2024. So if you've had this thing open for years, you're probably well into your filing. It may be that you filed a foundation under normal tax the last couple of years, and you probably want to do, if you're going to do something, you can do it this year. If you've opened your company more recently, so if you opened it between July 2024 to June 2025, I know that's quite a strange bracket, quite a strange time frame. It just works around the timing of the first financial year. Then your first financial year would have ended last year, so December 2025. And you're coming up to your first filing deadline in September 2026. And then for those of you that have opened your companies much more recently, so in the second half of last year onwards, you're still within your first financial year. So you can go ahead and, for example, do a transparency election now and have it apply, from the outset. And just a quick note for any of you who incurred that late registration fine, that 10,000 dirham registration fine, if you had opened your company after July, or it's from July 2024 onwards, okay, we can still get that waived, right? You've got 1 month left to get that waived if your company was open between July 24 and June 25. If you opened your company or your entity from July last year onwards, you're still within your financial year, but you just need to file. If you received that fine, you just need to file by July, so 3 months early, July next year, to get that 10,000 dirham fine waived. Okay, very common question, people coming in and saying, oh, I got hit with this 10,000 dirham fine. I didn't know I had to register my foundation. Quite often, if it's a recently opened entity, we can still get that waived by filing early. Many cases like that needs to be filed by the end of next month, by the end of July. Okay, we've covered a lot. Thank you very much for all the questions. Just a couple of points here. I know a lot of you on the call are agents. Okay, so you're agents. You've got multiple clients underneath you. You're attending this for for purposes of helping your own clients. Please consider us us, Virtuzone or TaxReady as, your back office support for this. We already support, hundreds of agents, whether it's, directly as ourselves, as a referrer or referee, or, we can provide it as a white label solution. So, as if it's you yourself providing the service, but obviously backed by our tax agency status, all of our security and everything like that. So, so please, if you are an agent here considering this for your clients, please reach out to us as well. We cover everything. Like I say, you can be under our branding, your branding, however you would prefer. Okay. And final thing, if for any of this, you've got further questions around it, or you want to go ahead and discuss this further, if you're in need of filing under an exemption, basically anything, we cover all of it. Like I say, we have got thousands of clients who we already help with this, hundreds of foundations that we've helped put this structure in place. Please go ahead, scan that QR code. It books a free call with me or one of the other specialists, and we can, we'll obviously go from there. Again, or just go to TaxReady.ae, go through RAC ICC directly. They can put you in touch with us, or yeah, scan on that QR code and book a call, and we can get things moving straight away. Okay, I will stop sharing my screen. So, thank you, everyone. I hope that was very, very useful. I know we covered a lot. I feel like I've hardly stopped speaking for 56 minutes. So thank you all. Johan, anything you'd like to add?
Yes, thank you, John. That was an excellent presentation. Thank you for sharing your expertise, especially on the UAE corporate tax considerations for holding companies and foundations. I learned a lot itself. It was very extremely valuable. Thank you. We appreciate your time and contribution. And I also would like to thank the Virtuzone and TaxReady.ae for partnering with us, with RAC ICC, to deliver this webinar. And again, finally, thank you to everyone who joined us today, who gave us their times. We appreciate your participation, especially with very, very deep technical, good questions that were there. And hope today's discussion provided valuable guidance that you can apply with your own clients. And as John mentioned, if you would like to consider TaxReady.ae is a website, and if you'd like to get in touch with them, you can get in touch directly with them, or if you want, you can also get in touch with us, and then we'll be happy to put you in touch with them as well. Thank you once again, and we'll look forward to welcoming you to another RAC ICC webinar in the near future, and have a wonderful day. Thank you again. Thank you, John. Thank you, everybody.
Thank you.
Take care yourselves.
Cheers. Bye.